This week in economics on the 7th of September 2014. Boston red here. It was an interesting week. We'll get into the numbers in a second here. Basically, the Fed is very satisfied in terms of its present posture on raising interest rates. The economy indicated there is slack there. The chair, Dr. Yellen, was correct in her assessment. And this goes back to normal trends in yesteryears. Usually at the end of August, a transitional day used to be a traditional holiday letting day in the U.S. Most workers took off during August if they had priority, in other words, vested in the organization. Thus, little activity is there. Most of the workers that were temporary started in late May or in June. And as we end August, they return to school or whatever. And businesses tend to slow down and pick up again in a week or so into September. So we see this not a surprise to us that it dipped, and we'll get to that number in a minute. We'll do it a little bit differently than what we normally do, and then we'll get to the market organization and their PMI, Purchasing Managers Index. We like to do it, and we'll get a little bit of commentary via the Bloomberg service on what the movers and shakers think, and from Reuters, what we'll have here, what Wall Street firms see as a possible rate hike in Q2 of 2015. Possible there could be one in Q2, in other words, second quarter, because you've gotten through the election year, and usually after an election year, which would be Q1, there you could see that. Now, a lot of that will depend on the holiday season in Q4 of 2014, and where it will carry over is an interesting situation in best. Now, the stock market has been doing much better, but other things have not, as one would say, clicked. And from Rosenkrantz, he is head of the Fed in Boston. The Fed should end guidance on timing of policy changes. Given the significant slack in the U.S. labor market, the Federal Reserve should be patient about reducing monetary stimulus and refrain from telling markets exactly when it will raise rates. Now, that's an interesting situation. Let's go to it first, and we'll jump back. That's an interesting situation there. If you recall, in the 2012 campaign running up to it, the presidential candidate, the Libertarian Ron Paul, continually pressed the Fed to open up his books, as he called it, to more transparency. Thus, the then chairman, Dr. Bernanke, started to do regular press conferences and to inform the public and the markets, if they were listening, as to what the Fed would do. Now, can the Fed tell the markets and the people exactly which moves it will do? It's kind of like a good private detective. No good private detective, according to the Nero Wolfe narratives, there would tell someone about exactly what they are going to do. Because the economy is very volatile. It's an internationalized economy. Dr. Kissinger had an excellent essay in the Wall Street Journal on the globalization of economy, geopolitical situation. We did something on his, and he's coming out, or has come out, with a book called World Order. He didn't say New World Order, but World Order. And it's being reviewed by various people, including the potential presidential candidate Hillary Rodham Clinton. I'm not certain what she knows about economy, but she does know about politics, and in particular she had been Secretary of State, so geopolitical. But now there's a blurring line between what we do in politics, or we exit off to political economy, which a lot of economists in the U.S. dodge. But here we'll do macroeconomics, and we'll stick with it. This is from Reuters, given the significant slack. We already talked about that. This is from Rosencrantz. As we approach levels of unemployment that many consider full employment, the Fed should no longer issue guidance on the approximate timing of any monetary policy changes. That is Eric Rosengier from the Boston Fed said in prepared remarks. This is delivered to the Bankers Association in New Hampshire and Vermont. I do not intend this to reduce transparency in monetary policy making. Rather, I simply want to acknowledge that any reference to calendar dates has the potential to be inaccurate. The Fed has kept short-term rates near zero since the Depression in December of 2008, and it has bought in its accommodation $2 trillion of bonds to push down long-term borrowing costs as well. With unemployment falling, it registered 6.1 in August, and we'll get to that in a minute because people weren't looking, so it went down a tenth of a point. Thus, the Fed no longer issues any precise estimates of how long it will keep its rates low. It does say it will probably not raise rates considerably until after the October considerable time. The October buying period that will end. Individual offices have offered more precise views of their preferred timing for rates to start. From St. Louis, you have Bullard pegging late Q1. I think we just talked about Q2, and several others suggest mid 2015. They're all in 2015. And analysts regularly provide these projections, which currently also fixes a likely first rate hike somewhere in mid-year. The mid-year they're talking about is 2016, reiterating an idea he floated in April. Rosengier said he would want to wait to raise rates until the U.S. economy is within a year of full employment. The Fed's goal, inflation goal of 2% inflation. And there's no problem with the 2% inflation. A large number of part-time workers would prefer to have to be in full-time. We'll get to that. So that is basically where the Fed is. And let's go to the actual statistics. This came out on Friday. Earlier today we're recording this. Actually, we're recording this Saturday morning, and you'll get it on Sunday. This is for August. The non-farm employment increased by 142,000 in August. The unemployment rate was little changed at 6.1. In August, both the unemployment rate 6.1 and the number of unemployed people, or persons actually, at 9.6 million, changed little over the year. The unemployment rate and the number of unemployed persons were down 1.1% and 1.7 million respectively. A number of major worker group, the unemployment rate in August showed little change. Teenagers, let me start here. Adult men, 5.7%. Adult women, 5.7%. Teenagers at 19.6%. It's been around 19 to 20, actually, for years. For whites, 5.3%. For African Americans, 11.9%. Too high. Latinos, 7.5%. Jobless rates for Asians at 4.5%. This not season adjusted, little change there. The number of long-term unemployed, those jobless for more than 27 weeks, and we talked about this before. 27 weeks is actually a short period of time. declined by 192,000 to 3 million. In August, these individuals account for 31.2% of the unemployed. Over the past 12 months, the number of long-term unemployed has declined by 1.3 million. The civilian workforce participation rate, 62.8%, little change there. And it's been effectively that since April. The employment population ratio at 59%, the third consecutive month, but it's up 0.4% percentage point from a year earlier. That would have been in 2013. The number of persons employed part-time for economic reasons, sometimes referred to as involuntary part-time workers, little change in August at 7.3 million. Individuals working part-time because their hours had been cut or because they couldn't find suitable employment. In August, 2.1 million persons were marginally attached to the workforce, down by 201,000 from a year earlier. And it's not the data is not seasonally adjusted. These individuals are not in the workforce and are available for work. Among the marginally attached, there were 775,000 discouraged workers in August. Little change there. The remaining 1.4 million persons marginally attached to the labor force in August had not searched for work for reasons such as school attendance, family responsibilities, etc. That we don't really dwell on very much. Total non-farm payroll employment increased by 142,000. We talked about that earlier. Professional and business services added 47,000 jobs in August and have added 639,000 over the past year. In August, management of companies, enterprises gained 8,000 jobs. Employment continues to trend up over the month in administrative and supportive services, 23,000 there. Architectural and engineering services, 3,000, and in management and technical consulting services, 3,000 there. Employment in healthcare increased by 34,000 in August within the industry. Offices of doctors, hospitals added 8,000 people and 7,000 respectively. Social assistance employment continued to trend up the month to 9,000 and has expanded by 104,000 over the year. Within leisure and hospitality, employment in food and drinking places trended up in August, 22,000. This is it's been up 289,000 over the year. Construction workers continue to trend up 20,000. That's a good number there also. This is in line with the monthly average of 18,000 the past 12 months. And trending up in Pacific trade contractors, 12,000. Construction of buildings, 7,000. That would be commercial. Manufacturing employment was unchanged in August, followed by an increase of 28,000 in July. Motor vehicle and parts lost 5,000 jobs in August after adding 13,000 in July. Automotive manufacturers laid off fewer workers than usual. That's usually always in the summer. They lay off to retool their factories. Fewer workers than usual were recalled in August. Elsewhere in manufacturing, there were job gains in August. In computer peripheral equipment, 3,000 there. Mineral production, 3,000 job losses. In electronic installations, down 2,000. Retail trade employment was little changed, down 8,000. Food and drink lost 17,000. This industry was impacted by employment disruptions at a food store in New England, and that was settled. They got their CEO back. Elsewhere in retail, automotive dealers added 5,000 jobs. Employment in other industries, including mining, lodging, wholesale trade, etc. Government with little change. In August, the average work week for all workers on private and non-farm payrolls was 34.5 for the sixth consecutive month. Manufacturing edged up 1/10 of an hour to 41 hours. Overtime was unchanged at 3.4 hours. The average work week for production and non-supervisory workers on private non-farm payrolls is 33.7. The average hourly earning for employees on private payrolls rose by 6% at $23.53. Incidentally, as nationwide strike civil disobedience by fast food workers who want to make just $10 an hour and have their dreams for $15 an hour, and this is phased in over a number of years. You understand the discrepancy here when we are talking about what was it, $24 as opposed to $10. Nonetheless, we will see more from the Bureau of Labor Statistics. They have these regular intervals out there. This is on the 5th. So at the end of this month, we'll see another one of these. Let's go now to the people at market with the PMI. So in other words, we're going from unemployment to what the purchasing managers are doing. Very important there. Service sector maintains sharp pace of expansion. Strong rise in business activities, but rate of growth eased since July. Payroll numbers increased further in August. Input cost inflation picked up in July, 15 months low. Service providers increased another month of strong output. New business gain in August, highlighting ongoing rebound in operation conditions through the summer. Increased workloads, optimism, and this is something we want to see towards the business outlook, contributed to a further rise in the service sector. Adjusted for seasonal influence, the final market U.S. Service Bureau Activity Index registered at 59.5 in August, down from 60.8 in July, but still much higher than a neutral 50. Although pointing to the slowest rate of output expansion for 3 months, the August index was well above the average since the index began in late 2009 in the Depression, 5.7 there. The latest increase was the fastest since May. Pressures on operating capacity and ongoing business development plans supported a further upturn in staff levels with the service sector in August. The current period of sustained job growth stretches back to March of 2010. Meanwhile, the average cost burdens increased in a solid pace, with the rate of inflation picking up from July's 15-month low. A number of survey respondents cited increased transportation costs and food prices, driven up by higher costs charged by service providers, rose at a faster rate since May. And however, the index signaled a strong pace of expansion, was well above the survey average of 55.7. The U.S. manufacturing sector's output outperformed the service economy in terms of output growth in August, 60.7 versus 59.5. Survey respondents wisely attributed the latest strong rise in business activity to improve domestic economic conditions and a corresponding upturn in clients' willingness to spend. August data indicated a robust increase in new business volume. The rate of growth accelerated from the 3-month low seen during July. Service providers' optimism towards the year-end business outlook also improved. So probably get our GMP up. Higher levels of new work lead to renewal, rise in outstanding business across the service sector. Backlogs of work have now accumulated in 3 of the past 4 months. And this is a comment from Dr. Williamson. He's the chief economist there. He said U.S. service providers enjoyed a bumper service, with companies reporting continual upbeat trading conditions in August. Alongside the booming manufacturing economy, the surge in service sector growth put the economy on course to grow to around 4% on an amortized basis in the third quarter Q3, similar to the expansion in the second quarter. Firms are still taking on staff in good numbers to meet further growth demand, with 2 PMI surveys suggesting non-farm payrolls should rise by around 200,000 again in August. Didn't make that, unfortunately. This begs the question of just how long policymakers will be comfortable with economic growth at this pace before raising rates. Well, we can tell Dr. Williamson it will be a time there. This was, let's see when he put his out here, on the 4th. So he actually was embargoed until the 4th, so he didn't really have a whole picture. Nonetheless, let's check our time here. We're doing okay on time. We can go to some other little tidbits. We took care of Rosengear in Boston. Let's get this is from Bloomberg. We'll get their take on Chair Yellen. Investors betting the Fed will accelerate its timetable for interest rates increase. May have to think again with the job numbers, no doubt about that. 142,000. It definitely takes pressure off of Yellen. That is from Markit, I suppose is his name there. The name, an economist at Society.SA in New York. It buys the market and the dovish camp more time. The payroll gains, which was strongest and most persistent forecast in the Bloomberg survey of economists. Yellen's view the underutilization of labor, that's a term we used to always use. Resources still remain significant even after the jobless rate fell faster than the Fed expected. The Fed's benchmark 10-year note dropped from almost 1 month high, and stocks fluctuated after the report. The 10-month note yield fell 3 basis points, 0.03 to 2.42. It was in New York, according to the Bloomberg bond trader data. Fed open market report in July repeated the benchmark interest rates are likely to stay low for considerable time, and it shall. Fed officials in June forecast the benchmark rate would rise sometime next year. And a little dashboard they have here in terms of where the jobs are suggests the Fed might move forward its timetable for rate increase intensified after the release of July's meeting. That was wishful thinking. The FOC is scheduled to meet on the 16th and 17th of this month. That's in September. And according to Michael Rowley, he's chief economist at J.P. Morgan Chase in New York, take their feet off the fire to make changes to the September statement. Some variance of considerable time is likely to remain in the committee's description of rate guidance. He's no doubt correct about that. There was always a tendency when you see a few months of job growth, which it has been, but we sometimes have to go back, and I usually don't do this, to some of the past history of normal fundamentals. And normally the summer months are slack, They start out with some intensity, but adding to the climatic conditions were very, very unusual. Long winter, a relatively short spring, rains, and all kinds of turmoil going on in some parts of the country. So that took things off a bit. And in retail trade, clothing, people were not buying fall. I'll get it right in a minute here. Spring or the summer clothing, because they were still in pockets. And thus that cramped that particular style. And also at the same time, the holiday season was fairly robust. So a lot of buying there, the big ticket items were taken care of. Of course, summer months you have house buying, that sort of thing. Normally, however, you don't have much in terms of big ticket items. We used to talk about computers, but we're talking about now washing machines, TV sets, etc. Smartphones, a replacement for those things, were booming along in the summer months. So we have to take all that into consideration. Back to Bloomberg here. Some analysts caution against reading too much in the latest data. Jobs have a tendency to come in low initially, only to show stronger gain after they adjusted. That can actually turn out to be reality after revisions. Payrolls were boosted by an average of 55,000 for the month of August, from 210 to 213, and a lot of that is a fluctuation with workers. But even if, say, it was 150,000 new jobs coming out there, it'd still be below what it should be. The Fed fixed jumbo at 4.53. The Fed fixed, 30-year fixed, that's the 30-year, is at 4.24. The 15 fixed is at 3.18. The 30-year fixed refi is at 4.2. The 5-1 ARM is at 3.32, one you should stay away from. And the ARM refinance at 3.27. So that's sort of where the Fed base was there. Let's quickly jump to Canada. Canadian unemployment fell in August by a record drop in private sector, undermining. Let me just get to this. Employment fell in August, undermining optimism about the Canadian economy. Well, the Canadian economy itself has had problems historically. There was some rescue with the flocking in Western Canada, but nonetheless that hadn't sustained the rest of Canada. Employment fell by 11,000, was unchanged at 7%. That's from Statistics Canada in Ottawa. Bloomberg had projected in the wrong direction a 10,000 increase. We can throw that out the window. The employment loss marked 111,800 decline in the private sector, a record total that equals a 1% drop since 1982. Certainly this is not an encouraging trend in employment. That's from Paul Farley, Assistant Chief Economist at the Royal Bank of Canada in Toronto. The economic growth rates won't be sustained. The labor market continues to contribute with increased hiring. Canadian currency also fell a 10% at, 1.0884 versus the dollar. The 2-year bond fell 1 basis point to 2.12. So in other words, the Tory government there isn't doing very well either in their economic plans. The participation rate, part-time employment fell by 8,700 in August, full-time by 2,300. That's Statistics Canada. Another 20,800 left the workforce, lowering the participation rate. in Canada to 66%. Retail wholesale employment led a decline by industry with reductions of 26,500. Transportation warehousing fell by 14,700. Manufacturing by 11,000. Construction increased by 24,400 in August. The public sector grew by 14,000. The average wage permanent workers rose 2.3% in August from a year ago, exceeding the 2.1%. We'll go ahead and, before the data was published, a fire alarm literally evacuated the place where the journalists were sitting. 7 reports, Statistics Canada said labor production, produced 1.8% in the second quarter, fastest in 3 months since 1998. Statistics Canada corrected the July report. It showed by employment rose by 41,700. It retracted a figure from a week earlier that showed 200 positions. Is an error there. So the Canadians had some errors that they had to, as one would say, deal with. Let's just do one more here while we are here and on to Mexico. Mexico has its rate according to the Banco de Mexico and their governor there, Augustine Carstens, at 3%. So after cutting the rate by 1.5% percentage points in the past 18 months. Consumer confidence remains weak. That's all around. And the inflation rate, which picked up to 4.7 in July, will drop below the 4 percentage point by the end of the year, and 3 in the first of next year. So inflation is relatively low in Mexico. The U.S. economy grew at an amortized rate of 4.2% there. So some positive signs out of Mexico. The central bank has at this point room to hold interest rates steady for a while. And that's from Mr. Hernandez there. So in Mexico, they will continue on. Let's go to the BBC and do the commodities and check the markets on Friday and see exactly where they were. So we'll get some idea as to where Europe is going. Apple incidentally increased its iCloud security after that debacle. And it was indeed a debacle there where photos of some people were distributed to the masses, so to speak. I'm not sure why they put them there. Who knows? Coca-Cola to adopt UK health labels, one of the things here. We'll go to Germany. We'll catch this quickly here. We try to go around a bit. The German industrial production jumped 1.9% in July. This is from the economic ministry there. It was the biggest improvement from June when the industrial production rose 0.4%. Last month, released figures to show the economy shrunk by 0.2%. This is interesting in the sense of the impact of the Russian Federation boycotts. Germany is one of its biggest partners. Factory orders, did we get this one? Rose 4.6 here. That was, well, let's just do it too. The strongest monthly rise in Germany's industrial output. They are the hands people, rose 4.6% in July. Despite concerns back to the Ukrainian crisis, foreign orders made up the bulk of the rise in demand, the ministry added. The figure was higher than any economist had estimated. Came in from a range of a 2.7 fall in output in June. The rise in industrial orders contrasts with figures last month from the economic ministry showing, we talked about that, the 2/10 decline in the economy. So Germany is on the move over the summer months. Let's go to the market data here and see where the markets were on Friday, unless otherwise noted. There are a few that don't report on Friday. The FTSE down 22.87. The DAC in Germany 22.76. In Paris, they were down 8.45. In Brussels, down 2.56. In Madrid, 48.80. In Zurich, they were also down 45.98. In Johannesburg, they were also down there, 294.82. In Bombay, down 59.23. Karachi in the negative, 84.91. Lahore also 30.35 in the negative. In Colombo, they were 26.81. And in Tehran on Wednesday, down 110.90. In Sydney, they were also down 33.20. The Nikkei was down 7.50. And Hang Seng in Hong Kong was down 57.77. In Shanghai, they were at 19.57. In New York, 67.78. The Nasdaq at 20.61. The Merc at 10.06. In San Pablo, they were down 118.04. And in Mexico also, they were down 81.96. To the commodities, and see if petrol or gasoline is inched up a bit. Brent crude futures was down 89 cents. The spot was also down $1. That was at 194 cents. The spot at 101.52 cents. Intermediate Texas crude took a bang also at $1.06 at $93.48. T-Boone Picker still jumping for joy. He remembers $15 a barrel oil. We're not getting the Dubai futures index anymore, so we'll just deal with the Forex gold index. Nonetheless, it lost $7 at $1,264. Silver was also down 8 cents at $19.13 for anyone still in silver. Oats futures were up $10.75 a bushel. That was corn, I'm sorry. Oats was up $4. Soybean futures were up $21.25. Wheat futures were up $6.25. Don't like to see that. And coffee was down $8 there. So that will do it for our report. For those in business, make next week a productive one. For the consumer, keep your eyes on the ball. And have a good rest of your weekend. Good day.